Lovely people, ladies and gentlemen, really delighted to have Peter Cavelti with me. Yes, a little bit of background on Peter, by the way. He's an author of numerous books, the ones we're going to be drilling down on the precious metals, but he's also written an intriguing novel. He currently does home office for select clients, having done managed well over $1 billion in his time. So he's a macro mind that we're looking really forward to picking. Peter, welcome and glad to have you.
Thank you, Francis. Delighted to be here.
So let's kick off. A man of silver and gold. We love a little bit of the inflation times. Give us your take. I would like you to sew in also the bizarre events that have seen us not get any commitments of trader information on the metals. I think I don't know if it's silver and gold or just silver. That's Russian hack narrative. And also just generally with regards to inflation and where we are right now, global macro, and your take.
Okay, well, thank you. So gold, what I always like to start with, let's just look back at the end of 2022. Gold was up against most currencies during a year, which was absolutely horrific in terms of financial asset performance. It was up 9% against the Canadian dollar, pretty well against the euro, 16% against the British pound and the Japanese yen. And in US dollar terms, in the year of the US dollar, basically, it ended up flat. And that speaks to gold's virtue as a portfolio stabilizer. And that's always an important lens. Now, so consider that even in US terms, when we go back again to the end of last year, to December 31, gold was up 21% for the previous 3 years, 45% for the previous 5 years. Now, there are different lenses through which we can observe gold, other than it's a great portfolio stabilizer, as I just explained. One is gold as a currency. I always look at each lens and make sure that the bottom line resonates. So gold as a currency, that doesn't take a big set of brains to see that gold as a currency is very, very attractive. Why? Because it can't be printed. When you look at the ocean of liquidity that has been printed by the central banks, and the amount of money that's been borrowed by the treasuries of different countries, gold as a currency shines. We can look at gold as a commodity. Now, to your reference to all these theories that are floating out there, the basic bottom line is that last year, central banks bought 1,136 tons of gold. Now, this is the highest ever since 1971, when Richard Nixon severed the US dollar from its gold backing. Now, that to me says a lot. And then we can ask ourselves, well, which central banks are buying? And of course, it's very logical. The central banks that are buying largely, they're mostly nations like what we call the BRICS. And why do they buy gold? They buy gold because the United States advertised through the Russian sanctions that they will basically seize any nation's central bank gold holdings just if you don't agree with the U.S. narrative, with the U.S. spin. And I would think that every central banker in the world is going to say, well, we have to minimize that risk, and therefore we're going to buy more gold. Now, there are issues, gold as a commodity, there are parts which look mixed, and that's mostly on the supply and demand side. We have ETF demand, exchange-traded funds demand, which was a huge factor in 2021. In the United States, down because the dollar was so strong. But in Europe and in Asia, it was up. But basically, people look at ETF demand as a big demand segment. And that is right now okay. It's not negative, it's not positive. Jewelry demand was down last year, and that had a lot to do with the weakening of numerous economies. But I view that as a temporary thing. And on the supply side, we can say, looking forward, that supply increases going forward are going to be very marginal. So that looks overall very good, mainly because of the central banks. Then we can look gold. The third lens is gold as an asset of last resort. And I always feel that that doesn't need much explanation. I mean, we're talking about not centuries, but millennia, during which gold has reliably been an asset of last resort, something that's transcends borders, is liquid, it can be bartered, can be traded. And of course, that has become a little less open during the past few years, mainly because holding gold in Canada and saying where I live and saying I'm now going to trade this in Switzerland is not as easy as it used to be. But still, within national borders, it is an asset of last resort. And you can, after all, also hold gold in different parts of the world if you so wish. And then finally, Francis, we look at gold's technical position. So that is probably right now, right at this point, perhaps the most intriguing, because we had this, what the technicians call an A advance that lasted from November of last year at $1,630 and ended in January at $1,960. That was followed by a very predictable B decline. And the B declines in the technical jargon are usually minimal and quick. And the B decline has led us very quickly from the end of January at 1960 to about 1815 a few days ago. And now we're at 1835 or so. So that means we did see the support we needed at 1815. And money is coming back into the market, which should in time, perhaps very soon, perhaps 2 months from now, lead to the C advance, which is the final leg of gold's technical movements. And that's usually the most powerful. And in my opinion, that'll likely bring us to, at the very least, the test of previous highs at 2050 or so, US dollars per ounce, and more likely, in my opinion, to new highs. Now, why do I say this? More likely, in my opinion, mainly because of the macro context of a very inflationary world, which is the consequence of many, many things. In the broadest terms, we have, for the last 5 or 7 decades, you can argue about the exact time span, pursued policies in the key industrialized nations that are utterly unsustainable. And consumerism was introduced in the 1970s and has been raging ever since, which means as society, we have been living today at tomorrow's expense. And this is the big, big thing. And then, of course, there are a whole bunch of sub-themes like the horrible fiscal position, the unsustainable, the monetary policies, unsustainable. We have now, due to COVID and the rules that different governments imposed, we have this perpetuated system of negative supply shocks, coupled with positive demand shocks, because governments keep putting money, into people's pockets. And so negative supply, positive demands equates inflation. And then
plus a war. Plus a war to boost that inflation. Plus a war.
Yeah. And that's, when you look when I do look at Britain or Europe, of course, those war-related inflationary pressures are more pronounced than they're in North America, which is a net energy producer, for example, and food producer, for example, and so on and so forth. But Europe is a particularly difficult situation. So you have the geopolitical situation, and also not just the war, but you have additional threats of escalation. And this is, I think, what the BRICS are really recognizing very clearly now, and they want to distance themselves from that. You see, this morning, in India at the G20 conference, they cannot come to a consensus as to what to say about the Ukraine war. This is the big headline this morning. Well, that shouldn't be a surprise to anyone because, again, if you don't dance to the US tune, you're stuck with sanctions, not just the central bank with its US dollar reserves, but imagine you're a tycoon in India, an industrial leader, a government figure. Anybody of stature is going to be targeted by this if the US thinks it's targetable. And so distance is very important for those people. And then in the end, you have also, which will also emphasize gold's value in a portfolio, you have the social challenges. It's a great surprise to me that we have not had a winter of discontent, of more visibility, especially again in Europe. Very big surprise to me. But when you think why might that be, a lot has to do with the government handing out payments and checks and stuff like that. And that, of course, aggravates, again, the fiscal position. And it negates if the central bank says, well, we're going to stop inflation by raising rates, but the government keeps printing more money and pursuing imprudent fiscal policies, that just neutralizes that.
I just want to come in on that. I call it the sort of the water and petrol approach to the fire. On the one side, they're pretending, making a big scene of putting the fire out on one end, putting some water on it. And the other end, they're putting the petrol because and we predicted this about 5, 6, 7 years ago, that you would actually have the perverse situation that you would have supposedly non-stimulatory rate increases while simultaneously having quantitative easing. And that has become almost a necessity, and it's a perversion, because you're either putting the fire out or you stimulating it. And in terms of the Europe, we actually considered much bigger blackouts. In fact, the three big things that were very precariously set, and they seem to have just taken their foot off the gas out of that. We had Europe that were looking at a dark winter with power supply down. We had China in full zero COVID. And then we had America's inflation still runaway. And then coming into sort of November, December into Jan, we suddenly had all of these miracles work out to better than anyone could have hoped. We had no lockdowns in terms of power grid downs in Germany, Britain, where many were potentially reasonable to forecast. And I can tell you all sorts of irrational things were happening because I still have a lot of South African context. They were exporting 700% more coal to Europe during this winter. They were literally going to Richard Bay live for miles long. These two massive container lorries in these centipede trails going forever. They pulled every stop in the book to actually keep the lights on. The damage behind the scenes that is done, it is really, we've watched someone band-aid over real problems. And the precarious nature of that. So those three big things initially all came in. We started to get the soft landing and then the no landing talk, guys. And then in the last 2 weeks, we suddenly had US PPI, Eurozone this week, and everybody's like, oops, this inflation monster doesn't die very quickly once you've let him get to teenage age. He's quite a strapping beast, and he keeps coming back at you. So actually, just if I can do a share here, I want to bring in shadow stats because I get the impression you're equally familiar with John Williams's work as myself, maybe even more so. One of the things that are really fascinating is the rates, the overall rates that we could in fact be seeing are approaching those levels. Are we? The next question I suppose I want to put to you is: are we already in an environment where we are having the Volcker, we are at Volcker level numbers? Because if I just take you to the shadow stats, I'm opening that showing now. You can see on the blue diagram, and I'll just scribble to make sure everyone who's watching can see it as well. Over here, we're actually being through 15%. Let's go with pink slightly brighter and a fat Koki. So the blue line, the 80s, so that's 83, that he started around 82-ish. That's the rates where the inflation rates are the same. The red line is the legacy in the new inflation rate with new bent measures that is diverging lower. The blue line is using the same measures as the era that coincided with the Volcker spikes. And of course, the key theme of that, bringing us back to our primary question, gold and silver. So America, by its own stats of 1982, has gone well past 15, potentially, and I'm not, the scaling isn't excellent, but you're roughly midpoint between 20 and 15. So it sounds quite reasonable that by shadow stats' measure, you've already seen a figure of at least 17% by a Bank of Labor, by BLS stats that existed in that period, that they've since hoodwinked to do, window dress. So are we not already at the Volcker crisis? And surely gold and silver should be significantly higher if we're really looking at a free market and free discovery. Let me give you a chance to respond to that.
Yes, well, I think this is very relevant, what you just demonstrated, and I think we have enormous similarities, and I think this could actually be just as bad or worse than what we encountered in the latter part of the very late part of the 1970s. Just to give you an example, when I wrote my first book on gold, How to Invest in Gold, which was published in Canada and in the United States, and I think in Germany as well, by that book, when I wrote it, gold was about $100. When that book hit the shelves, when it first came out, that book, the gold price was around $300. And very, very shortly after, within a matter of months, gold was at $852 in January 1980. And when we try to demonstrate that this inflation that is being in the works right now, it may rival that of the late 1970s, and you get into these debates. The answer you always get from the economists is, well, the Fed will not allow that. What's totally ignored and rarely is talked about is that this is not one man's decision. Volcker had ultimately far, far more control of the situation than exists today. Again, going back to, we have now governments basically around the industrialized world that are making the central banks work almost impossible, because they just keep borrowing. And so it just neutralizes the Federal Reserve's work. And so it may take much, much more determination to kill inflation this time. And of course, the economy is far more vulnerable because, in the 19... Sorry. I was...
No. Carry on.
In the late 1970s, the European economies and the Japanese economy were a counterpoint to the United States economy, and they were not suffering from the same inflationary pressures and all this stuff. Now you have a uniformity across the industrialized world. Japan is a complete train wreck. Europe is in horrible shape. And the United States is also in bad shape. So it's very likely that we're going to have rising inflation pressures. And at one point, that narrative that is being advanced by the economists, that the central bank can just control this like that, is going to collapse. And I think that's when gold and when inflation hedges are going to come alive.
I think the point you're making is so on the money. In fact, I would argue there is no way that it is only to the scale of Volcker, because a large part of America was Vietnam and the unhooking of the, it was quite American-centric, whilst now, essentially, we are in a leper colony of hyper-financialized states, the entire West. So, the debt levels are significantly higher. Even during the 70s, the late 70s into those early 80s period when Volcker was cracking, as you say, he was committed, he stuck by his guns. He had more scope, I think, to do that than Jay Powell certainly has. I think derivatives have got bigger. Here's the reasons why I think it's significantly worse. Number one, it's globalized. It's not just largely an American phenomenon. Number two, demographics. You've got the nation states of the West all in an aging, declining, population reducing numbers. The productivity spike is not in front, it's behind of the most productive age, which is normally deemed 46 and a half years old. The third option is you actually have a war that is far bigger, I would imagine, potential to escalate further and involving. You've got the bifurcation of the supply chain, which further cuts things in absolute half. And then you've got this entire social undermining where it's no longer meritocracy. Even during the 70s, generally you hired the best man or woman for the job. So we've actually got this complete inversion where competence and meritocracy and the true price discovery, all the relatively virtuous capitalistic ethics have been abandoned. And I can't see how this doesn't put it in the much worse than Volcker era, because, and we were both in the same room in the same discussion when Mr. Doom and Gloom, Mark Faber, was just pointing out the possibility could be, I think many things will fail before, but you could have a scenario of extreme interest rates. A lot of things would fail, maybe they'd have to do exclusions, but he said, you have to think like that, even if it's technically not possible, whilst not espousing it as one of his views. And when you look at the stats and the inflation, we should already be at those levels of rates, shouldn't we? If we had a Volcker now today, and a whole bunch of things would have broken.
Yeah, I mean, that's the, at one point, either rates stay in real negative terms for a long, long time, which is my kind of prediction, if you will. Although I hasten to say, Francis, that we seem to totally agree on what lies ahead. But I have to tell you, I have never been in this kind of mode financially where I continuously tell myself, be prepared for many different outcomes. Be completely agile. Reassess every week. This is so important right now. And when you look at it from that viewpoint, and the thing that's the most fleeting, the most unpredictable is, of course, not the direction, but the timing, right? Where is a pivotal moment when people suddenly recognize something that they didn't recognize before, and the psychology of the crowd changes dramatically. And those are the points when you want to be positioned, because you have a slight advantage if you are really vigilant and agile. You're a bit ahead of the crowd, and that's really important. Yeah. But if you look at it that way, of course, then you can't just look at gold alone, and you can't just look at, let's say, for example, gold is very important. I think an exposure to BRICS is important now. It doesn't have to be a huge exposure, but the BRICS complex is one that can beat you call it the West. Let's say, the West's overall economic potential. You have to ask yourself, what are the key things that you look for? And what one of them to me is indebtedness is your enemy. And for that very simplistic reason, I don't own any bonds. I don't want to have any bonds, because a bond is the liability of another party. And a bond gives you two aspects. It gives you a promise of repayment, and that repayment capacity is much lower in every segment of the bond pie than it ever has been in our lifetimes, let's say. The second thing a bond does, it rewards you for the risk you take, accepting somebody else's liability by paying you an interest. And those interest rates are not very attractive. They're when you juxtapose them with inflation, then they're extremely unattractive. So bonds are out, and then you come to stocks and you say to yourself, what matters here? I think the most important thing is that, again, top down first, is that the traditional way people invested, which was to buy and hold, is dead. The traditional way people invested, which was the 60-40 recipe, 60% equity, 40% dead, right? In fact, if you held 60-40 in the context of the United States, you'd be right now 14% below the peak that was reached about a year and 2 months ago, something like that. You'd be down substantially. And so within the stock market, with stocks, at least you own equity. It's not somebody else's liability. You're a stakeholder, just like the commodity or with real estate.
But within that, if I can jump in, there's so many very badly overextended and deeply in trouble industries, of which the financial, in the same way that we have the hyper-indebtedness, which is currency and bond market, because the one exists as a result of the other. We have the banking sector. We have the hyper-financialization and assets inflation that came before the consumer price inflation. That was the technology majors. And in fact, we're seeing a substantial correction in Amazon on account of destroyed retailer. Google has continued to trade down. These things have been hyper valuations. They're needing to be viewed more jaundiced eyes has to be cast over them than before, and the valuations that we've got. So outside of, there are some hotspots like the military industrial complex, surprise, surprise, and miners potentially. But this is also going to be a bit of a stock pickers and an industry specific safe place for equity. It's not universal. I could see equity indices actually being sideways or down over quite substantial time frames, but there's been a sector rotation in that. Talk to us around that, or do you concur?
Well, I think, overall, valuations right now, if we take seriously at all the possibility of a recession or even a soft landing, the valuations in the stock market globally are way, way too high. However, within the stock market, of course, you have, as you point out, pockets which are attractive. And, what we look for in the stock market are strong balance sheets, sustainable cash flow, and ideally a big moat around your business model. And if we really get idealistic, we want businesses that reinvest profits in their own model and don't just buy back the stock. Those are the four criteria we look at. So I give you a good example, just one. I almost as a policy, I never mention stocks in these webcasts, but I will use one just as an example. So the typical valuation in the stock market is about 20 times earnings, okay? So I look at an industry leader you mentioned mining, and this is why I bring it up. Rio Tinto, 9.5 times earnings, 6.4 times cash flow. So that makes it, to begin with, about half the valuation of the market average. Rio Tinto has 19% debt, very, very low debt load. It generates enormously strong cash flow. It has a dividend payout ratio of 64%, which is very sustainable. and it yields 6.77%. So what we do with a stock like that is we wait for a little intermediate rally, and at that rally point, we write out of the money calls options. So if Rio Tinto is at $74, we sell $79 call options, maybe 3 months out. And by doing that and rolling, and we really rarely ever get assigned on these things. And that boosts our income on that stock, that dividend yield of 6.8%.
These are covered calls because you own the equity as well.
Yes.
You're right. Yes. So just for people that are listening to that, these are covered. It's not a naked short position.
No.
You own the equity. Yeah. Sorry. I just want to qualify that people may not.
Absolutely. No, that's very important. Yeah, we own the stock and we collect the dividend because we own the stock. And then on top of that dividend, we pocket the call option premiums. And so that gets our income per annum to about 10%. And that's a good example. Now, when you look around, there's some things you mentioned, the military-industrial complex. I can't personally get myself to invest in that, ever.
I know.
That's like big pharma. I can't do that. I can't buy Pfizer or, Eli Lilly may be a great stock, but I can't do it. But
I like also that you included pharmaceuticals in the military-industrial complex, by the way.
Yeah.
Because that's exactly how I view them. A weaponization against humanity.
Yes, and that's we see things alike. And so, but for example, I look at in the Canadian market, for example, I look at the two big pipeline companies, and they both have their moat. Nobody can take that business model away from them. They pay enormously attractive dividends. They generate great cash flow.
Which two are they for the lack of the under-initiated? By the way, none of this is advisory. Speak freely. You're okay to mention names. No one's coming back at you.
Yeah.
Who's your pipeline faves? The two Canadians. I should know them. I don't. Which ones are they? We'll bring up the charts while you're talking.
Well, we have Enbridge, which is one of them. And then we have what used to be called Trans-Canada Pipeline, which is symbol TRP, and is TP Energy now. But it just, and I'm not directing anybody's focus to Canada specifically. If you look in the United States, you have similar companies that in Australia, in some cases in Europe. I look at things like in Europe, like Nestle, for example. That seems to be a business model that's not going to go away anytime soon. And many things that Nestle does kind of resonate with me. For example, they're on record as having said on numerous occasions that the MBA model of reporting earnings and data quarterly focuses you too much on the short term. And therefore, they see that as something that is not really preferable. So there's philosophical alignment with some company that we have. I
will remind you, though, that Nestle is the one with the CEO who says the water that falls on your property does not belong to you, who wishes to bottle all nature's resources and strip us of those that freely land on our territory. Famous.
Now you've taught me something I didn't know, Francis.
He's leading that charge. And he's also gone upstream of many natural rivers just on the other side of legal boundaries, and they bottle water. They make an unbelievable amount out of water and bottling, and they are an attack vector. He's very Bilderbergy. The name escapes me, but just so that you're aware, if you hadn't heard that, because there was something that came as a shock to me.
Yeah. No, my point is that when you invest, my philosophy has always been to stress not making money, but preserving wealth in a clever way and an aware way. And I as a person, as an individual, I don't want to invest in things that are not ideologically aligned with my thinking. I won't do that. However, what just happened just now in regard to Nestle, when you learn something from somebody that you weren't aware of, then it comes as a surprise, and then you reevaluate. But it's important to be true to yourself, I think, when you invest, and you seem to think that as well.
I do. The pipelines, the energy infrastructure, which, as you say, are very much toll roads, close to what Warren Buffett used to describe as the only bridge across the river, are genuinely quite lowly valued because we've had this Uber tech is everything, which I consider also a dark state investment category, and are quite undervalued for their cash generative ability and their barrier to entry, which is such an important consideration, is huge, and it's practical. And we're almost going back to some physical things. And I do feel if we have this next level depression, because I can't see it not being a globalized and of depression standard, that might make me a little bit too pessimistic to some. But when we discuss the demographics, the unsound money, the perversion, inversion of culture and values, the extremity of debt, the synchronization of that extremity of debt globally, the fiat proliferation, the monetary policy supposedly tightening while actually doing quantitative easing on the side, all these perversions, I don't think it's unrealistic to expect that. A lot of people are going to come back down to just wanting to have a place they live that's safe, well-fed, the basics, the lower echelons of Maslow's hierarchy of needs will start to show great value. And these corporations are feeding that. So I like the idea of just pipelines generally. You don't knock up a pipeline. You don't get the planning permission easily to do that. There's not active competition of one running next to the other. It doesn't work that way. So you tend to hold close to monopolies, oligopolies at least.
Now, that doesn't mean that we don't have to revisit the theme again and again and again every 2 weeks, because one of the things with the pipelines and many stocks renowned for their dividend-paying capacity are going to be juxtaposed against rising interest rates. And so, if you could get 5% yield on a pipeline, for example, and all of a sudden term deposits at the banks pay you 5.9%, that's going to be drawing capital from that back to bank deposits. And this is the ongoing theme. You like I said, you have to be prepared for many, many outcomes, and you have to adjust continuously. Yeah.
The one thing that's different to the Volcker era is that it was a consistent stagflationary period. What we have now with this weaponized central bank is that we keep getting this whiplash of volatility between inflation, then followed by huge amounts of disinflation into economic collapse, where even having a negative yield in an instrument is better than losing everything. Or cash under your bed is almost better. Even though there's very high inflation, you're getting the similar stagflationary growth going down, going negative, and many other things losing more. So there can be a point where you've got this on and off, this binary sort of lights on, lights off, risk on, risk off. It's very much a phrase of our times, with the automatic central bank riposte to its own volatility that it's created, which just keeps this volatility. While Volcker was actually, he was sailing a specific course and he adhered to it for a sustained period. Now we just seem to be in whiplash mayhem. And this is what tends to bring the confusion, I find, to the investors and also the traders, is what are you positioning for? Are you positioning for the inflation narrative, or are you getting wrong-footed? So you buy a whole bunch of gold and silver, and then they absolutely crash everything. They hack banks, they kill money, everything goes down. You actually get a little bit of bid in bond potentially, which I'm not interested in having, but I don't think they ever go that all the way up in value and yields ever go down. But you get a bit of bid, that inflation is still ridiculously high, but right now you're in this sort of, let's say, events of March 2020 environment, semi-depressional or 2009-ish post-subprime environment, where actually everything is contracting and even losing money in a certain instrument or an equity in an infrastructure play that's not got ridiculous valuation, not quite got the yield enough. So you're getting 5%, but inflation is 10 or 12, and the banks are paying 4. But you lose less. How do people plot a course for the fact that we get such a wild swings that didn't exist in Volcker's case in the disinflation inflation narrative? Or should they just hold the horizon view, which is it ends in inflation, and not sweat the bumps in the road that come? How do you play that?
Well, the horizon view is a bet. The uncertainty and volatility of the moment is a reality. And so I would think what that really stresses, that you bring up a very important point, is that cash is a key asset class. And that is, you have an entire generation of money managers who do not understand that. It is frightening to me.
All in.
Yeah, it's all in. And, you know, we've been here before, and recessions never last longer than X, and downturns in the markets are always countered with more accommodation monetarily and fiscally, and therefore, no, you know, just be fully invested, and the market keeps coming back with ferocity over and over again. And you know, when you're a veteran of the 1970s and 1980s, and you were there in a money management context, then you understand that bear markets can last for a long time, and sideways markets can last for a long time. So cash is very, very important. And I think the other factor with cash is if the market really goes back to normal market multiples, and we get a poor economy, then you can redeploy some of that cash. And by then you have a much clearer understanding, is it an inflationary recession or is it going to be a deflationary recession? And when that becomes clear, if it's an inflationary recession, but it is a recession, stocks are coming down, you can deploy your cash position or part of it very wisely and put it into things that benefit in an inflationary environment. And that's why, again, you know, the old buy the market, buy an index, buy a series of ETFs and just hold them is making no sense whatsoever. So, you know, you can ride the little waves and use cash, or you can wait for something bigger to happen. And yes, inflation is going to eat away 3 or 4% of your cash, but probably in a context when the market would take away 10% of your assets. And that is the important thing. The most important lesson of investing to me is, when things go bad, if you can lose less than all the others, you're a genius. You've done really, really well, you know. And that is, you know, outperforming in an up market to me has never been very important. But outperforming in a down market, you know, when the market is down like it was last year, 20% or so, and you're only losing 3%, well, that's a real accomplishment. Yeah.
That real accomplishment. And that's spoken like a true risk manager who realizes that drawdown in terms of money management is the biggest pain, particularly when you're looking after other people's money, because they all panic out after bad news and bad years, typically Pavlovian responding in the worst possible way. And if you're running a fund, you get mass redemptions at just the time you need it least, because then you become a forced seller at the bottom of a market. So yeah, very good statement. Managing the risk and outperforming in the hard years is where it's really at. I've really enjoyed this, Peter. To direct people to your website where they can benefit, let's go share screen on that. So people who've enjoyed our discussion here with Peter are welcome to find and go and register with he has a strategic newsletter. What can people expect to see there, Peter?
Well, I generally publish, if you go on our website, cavelti.com, what you see is a tab saying research, and our research is free. And we're not going to try and sell you anything. Our research is free. You've got the books tab. This is the, if you go to the middle, research, and you go to the bottom of it, then you see a collection of our published research. I publish whenever I have something to say. For example, in early January, I commented on the fact that the new narrative that we were served, the new consensus was baloney, that now, the dollar was definitely on its way down. I do think that's going to happen, but it's going to progress slowly because it's a relative game. I also felt that the narrative, the new narrative that interest rates were now going to come down again and the Fed could be less aggressive because inflation was down a tad for one reporting period, that wasn't going to play out, and so on and so forth. Now that it's changing, I'm going to write an update anytime now. I park webcasts on there. I park our research on there. And as I said, it's completely free.
Just on that point, you raised a very interesting point. What's your response on the dollar to initially, long run? I think we both agree that it diminishes in global relevance, but it's not going to go away overnight. A lot of big industry, it's going to take a while to break everything good of America. And also in this rate tightening and this bifurcation along with this BRICS versus the old order, if we can call it that way, when the euro came out, it was noted that the Americans leaned very, very firmly on dollar strength. And the euro came out at, I think, around 120 or 140, and it fell all the way down. I don't know if you recall this, to 80 cents to the dollar. So it fell well through the parity. And it was almost like the old silverback orangutan or gorilla was just reminding the new kid on the block who was the biggest ape of on that plantation, so to speak. And now it's facing this. There's many people that say, despite the world's functionality, most things are still dollar denominated in terms of derivatives, various other things. So there's still a need for dollars. And if the Fed gets on the front foot on the rate escalation, which is basically the theme of last year, the 2021 strength of the dollar, Britain had their drama. They threw their prime minister of 1 month under the bus and the financial manager. But the Bank of England actually raised rates slower than America did. And that wouldn't have helped global macro hedge fund managers and treasury departments of big corporates would have gone where their money was being treated best, higher rates and better currency appreciation, and that would have reduced the bid. Yes, there was also talk of running deficits and more debt. That didn't help, but they were trying to pursue a growth agenda. So my overall view is the dollar milkshake theory that's been espoused by Brent Johnson and the Chiffin's dilemma that I think you might have made reference to. I've had other people make reference to recently, where the need, so much offshore dollars, they need that continual production. And with the Fed now tightening and not adding particularly significant QE, they're supposed to be withdrawing. I don't think it's particularly much, but there's a token amount that they were withdrawing. Do we not actually run into, before the death of the dollar, more volatility and a potential super spike based on denying dollars outside of America, which then leads to problems with debt repayment? Most of the borrowing by the BRICS nations are in debt. The whole Triffin dilemma, that they are exporters of dollars and deficit runners of everybody else's product. How do you respond to this theory? Because everyone often just goes, well, it's straight to the death of the dollar. And I think there's often a few more twists in the tail before that eventual outcome, potentially.
Well, I think two responses. Number one, the dynamic you mentioned is a very valid one. And basically, interest rate differentials are always a big trigger for capital conversion. But and you have all these debt dynamics too. On the other hand, you really have a United States that served large economies notice that holding dollars and being aligned with the dollar as a reserve currency, with U.S. platforms as an international settlement mechanism, U.S. control of the IMF, U.S. control of the World Bank. That whole post-war order is now something they want to distance themselves from. And I'm not talking just about nations that are hostile to the United States or have been put into a position where they're deemed hostile to the United States, I should say, like China. But also I'm talking about historically aligned countries like Argentina, Brazil, for example, Nigeria and Africa. Those are all countries that are at risk if they keep the dollar-friendly platform. So over time, I think there's going to be a huge disengagement from the US dollar worldwide, but that is over time. Just because that's inevitable doesn't mean it's imminent. And you have, in the meantime, a situation where we all know that capital flows are always based on relativity. So if you're in the United States or in Canada, things look really lousy. But I always remind my colleagues and friends in the US and in Canada that they're much more lousy in Japan or in Europe. And so the relativity is going to continue favoring the US dollar. And I think also you have, when you look at interest rate differentials, I think the Fed basically has the capacity of raising rates quite a bit higher before the US has to endure a really serious recession. I don't think that's the case in Europe. I think in Europe, and at one point you're going to get a
divergent.
A diversion from the currently coordinated interest rate policy. And so
someone breaks first, and it's the weaker ones, and it's not America. I'm surprised derivatives haven't broken, but if it doesn't come down to derivatives, which are generally trans-Western, if it comes down to individual economies, it won't be America that folds first. I think they can take more pain, and Euroland is going to be up there. And what about emerging nations?
Yeah.
Surely we're going to trigger that. I mean, Turkey has finally got the lira almost quasi-stable for a period now, but that's a hellfire. South African rand is at close to records now against the dollar. You've got a lot of the borrower nations that could go into real trouble with that. So certainly in an arm wrestle, I wouldn't want to push against the old silverback orangutan. Is still pretty tough.
Yeah, I agree. And that at the moment is, why gold's advance. Gold is always oriented toward the whole sustainability of what is going on, and is very particularly sensitive to inflation as well. On the other hand, gold is always seen as an alternative to the US dollar. And the two of them have very poor correlation. Dollar goes up, gold goes down. What I would argue is that gold is supported by the former two dynamics I just described. But from a dollar viewpoint, the kind of breakthrough, all is possible movement in gold is going to be delayed by the dollar for a little while longer. Will that be
just why you must continue to look at gold versus the other crosses as well, not to be
correct
undersold on that. I mean, the gold against the yen and the pound chart is phenomenal. It's close to all-time highs. And the weaponization of the dollar, the Fed knows better than anybody else. If you listen to Ron Paul's discussions and things that he was involved with Reagan very early on about studies on the gold, and he took on Bernanke a lot on this, who said it was just a traditional asset. All of these things, they know they have to keep gold from highlighting the situation. The last thing they want is a gold bull run. So that will push dollar strength because most places quote the dollar price. So this is why I think we have technical setups for a dollar spike against a number of quite big non-emerging nations. And I suspect as part of that death, we actually get a final flurry of potential strength first in an artificial way, but it will probably be Fed induced, and they're going to continue to try assert the dominance of the dollar. The dollar is a weapon. It's a financial weapon. It's same as the military industrial complex. You need to view it as one of their primary, strongest trump cards. It's a weapon along with what they throw into the mixer with the likes of Lockheed Martin and Raytheon. Anyway, we extended a little bit. Peter, thank you so much for your amazing time. To summarize, go to the research page on Cavelti.com to follow up with Peter's great research. It's entirely free. Enjoy that. Thank you very much for coming on and sharing your views with us, Peter Cavelti.
It's been a pleasure, Francis. Very much so. Thank you.